Welcome to the Investors Trading Academy, talking glossary of financial terms and events. Our word of the day is antitrust. Antitrust is a government policy for dealing with monopoly. Antitrust laws aim to stop abuses of market power by big companies and sometimes to prevent corporate mergers and acquisitions that would create or strengthen a monopolist. There have been big differences in antitrust policies both among countries and within the same country over time. This has reflected different ideas about what constitutes a monopoly and, where there is one, what sorts of behaviour are abusive. In the United States, monopoly policy has been built on the Sherman Antitrust Act of 1890. This prohibited contracts or conspiracies to restrain trade, or, in other words, of a later act, to monopolize commerce. In the early 20th century, this law was used to reduce the economic power wielded by so-called robber barons such as J.P. Morgan and John D. Rockefeller, who dominated much of American industry through huge trusts that controlled companies' voting shares. DuPont Chemicals, the railroad companies, and Rockefeller's Standard Oil, amongst others, were broken up. In the 1970s, the Sherman Act was turned against IBM, and in 1982 it secured the breakup of AT&T's nationwide telecoms monopoly. In the 1980s, a more laissez-faire approach was adopted, underpinned by economic theories from the Chicago School. These theories said that the only justification for antitrust intervention should be that a lack of competition harmed consumers, and not that a firm had become, in some ill-defined sense, too big. Some monopolistic activities previously targeted by antitrust authorities, such as predatory pricing and exclusive marketing agreements, were much less harmful to consumers than had been thought in the past.